You were told that a six-figure salary was the finish line, that if you hit that number, you had made it. But for nearly half of the households earning $100,000 today, that income barely covers the basics. This bar chart measures exactly how far a paycheck stretches, tracking the cost of a standard middle-class basket of goods, a modest home, healthcare, a car, and groceries. It shows that in 1985, a typical breadwinner could cover all of those annual expenses with about 40 weeks of labor. The GDP measures total output, not how far your paycheck actually goes at the kitchen table. This squeeze on the middle class reflects more than just individual financial choice. The pressure is the result of a structural breakdown in the global financial machine. To understand why your local rent is skyrocketing and your savings are draining, we have to look thousands of miles away at a chain reaction of macroeconomic dominoes falling in overseas markets. In the 1970s, the United States abandoned the gold standard and inflation spiked. When oil-producing nations declared an embargo, prices quadrupled. Americans lined up around city blocks hoping to get a few gallons of gas. The U.S. desperately needed a new way to anchor its currency. In 1974, Henry Kissinger went to Saudi Arabia and engineered a solution. Behind closed doors, they struck an arrangement. Saudi Arabia would sell its oil exclusively in U.S. dollars. This flowchart illustrates the Petrodollar System. If any country on Earth wanted energy, they first needed U.S. dollars. Once they bought oil, oil-rich nations took those dollars and invested them right back into U.S. Treasury bonds. The world's need for energy created a permanent, insatiable demand for the dollar, financing Washington's debt and absorbing American inflation. After a half-century, that closed loop is shattering. Major oil producers are trading in yuan and rupees and executing transactions on independent digital networks that completely bypass Western oversight. America sits on $39 trillion in debt. That balance sheet, totaling more than $110,000 for every citizen, only stays stable because the rest of the world is forced to buy dollars to survive. As that demand dries up, the cost of holding all that debt falls directly on the American public. At the exact same time, America is losing its other most reliable customer. For decades, Japanese institutions borrowed yen for almost nothing and converted it to dollars to buy higher-yielding U.S. assets. It acted like a critical liquidity buffer for the American economy. But Japan's population is caught in a demographic death spiral. They are losing around 500,000 working-age people every year. To protect their currency and stabilize their eroding tax base, the Bank of Japan was forced to end the era of free money. They raised interest rates, which closed the gap that made borrowing yen so profitable. A significant volume of capital is now quietly evaporating from the global system, as Japanese megabanks and pension funds dump American debt and bring their wealth back home. Losing Japan's purchasing capacity right as the petrodollar begins to crack creates a vulnerability in the system. The foundation underneath the U.S. bond market is pulling away. With foreign demand thinning, the U.S. government still has a $1 trillion annual interest bill to pay. To convince the remaining buyers to absorb that debt, the Federal Reserve is forced to keep yields up. And when long-term bond yields climb, the 30-year mortgage rate climbs right along with them. This creates an immediate squeeze on anyone trying to build a life on credit. Millennials and Gen Z are hit with near 7% mortgage rates and soaring auto loan costs, completely boxing them out of the ownership class. This scale diagram demonstrates exactly how that policy splits the country. While borrowers are crushed under the weight of expensive credit, those high rates provide an automatic return for the older demographic sitting on trillions in cash and short-term bonds. That extra interest income flows straight back into the service economy. Older demographics use this automatic pay increase to book premium cruise cabins, luxury travel, and high-end healthcare. They spend without borrowing, which keeps inflation permanently high. The Federal Reserve's primary tool to cool the economy is actually fueling a $79 trillion wealth transfer that actively works against the working class. You can see the collateral damage in your own neighborhood. Today, nearly 1 in 3 home purchases in America is made entirely in cash. Cash-rich retirees and institutional investors are completely immune to the Federal Reserve's rate hikes. They easily outbid young, mortgage-dependent families trying to buy their first property. You cannot out-earn a buyer who is paying with the yield generated by their existing assets. Entry-level housing has evolved from shelter into a high-yield extraction vehicle for those who already hold capital. The basic requirements of human survival, housing, healthcare, and childcare have been financialized. They operate at scale to extract maximum profit from your wages. Workers are producing more value per hour than any generation in history, but the reward for that efficiency goes directly to shareholders. The historical link between putting in a hard week of work and accumulating wealth is severed. Working your way to the American dream is mathematically impossible in a system that rewards ownership over labor. The only way to navigate this new economy is to recognize that your paycheck is caught in the crosshairs of global debt and adjust your strategy before the next domino falls.